Okay, hello everyone. My name is Mike Eichenbaum, and you are here for our fifth installment of our ASL tax reform series. And this series is tax reform and the impact on real estate. Just wanted to let you know that we have one more coming up webinar, and it's going to be tomorrow at the same time, noon. And it's tax reform for the pass-through entities. And actually, I encourage everybody who's listening to this one, go to listen to that as well. I think there's going to be a lot of good overlap and for real estate investors, as many of you invest in pass-through entities with your real estate. So I would encourage you to sign up. There's still plenty of time to sign up right up to the time of the event. I just wanted to also let you know that we have some few items we wanted to bring up with you. For questions, please go ahead and forward your questions anytime. You can use the Q&A feature at the top right corner of the screen. We'll probably try to answer as many as we can at the end of the presentation. If we don't get to them, we do have a list of your names and email addresses, and we can get those questions answered for you shortly after the presentation. Also, you can print the slides and save them if you want. You want to take notes for, or at a later point to just refer back, go ahead and click the multimedia button in the top right corner, and it's going to bring up that presentation for you. There's no CE credit if anybody was looking for that when they were signing up, unfortunately. We can't offer that for this, but this will be very good information for you otherwise to be able to use in the future for when we're going to start implementing all these new tax rules. If you have to leave early or you'd like someone to share the presentation with a colleague or friend, the webinar will be posted on our YouTube channel, our ASL YouTube channel, within the next few days. Also, a brief survey is going to pop up at the end of this webinar. You can enter your contact information if you'd like someone to follow up with you. We always appreciate feedback. So with that, I'm going to go ahead and get started. I am Mike Eichenbaum. I'm a tax manager here at ASL. I've been doing taxes mainly with real estate and partnerships for the last 10 years. Lots of experience with like-kind exchanges, residential, commercial rentals, real estate development. Also, I would go ahead and say hi to Yvette and Erika. They're part of our panel here.
Hello, everyone. Hi, everyone.
And they're going to go ahead and share in some of the information we're going to provide you today with some of these new changes or enhancements to the tax law regarding mainly a focus on real estate. So our topics are going to be the brand new pass-through entity deduction. This is going to be, a good meat of our discussion, and again, this will be I think this will be a big part of the discussion tomorrow as well. This is something that we haven't seen before, and we're going to get into some detail today on how that works and how complicated it's going to be, and how we think that with a little bit of advanced tax planning, we can try to maximize that deduction for you or see if you even qualify. We're also going to get into some changes on our like-kind exchange rules, enhanced business asset expensing, changes to individual mortgage property tax deduction, and the limitations on pass-through and net operating losses. So I'm going to go ahead and get started here with this new pass-through entity deduction. Really, it's a deduction not only for just pass-through entities, which when we say pass-through, we kind of refer to partnerships and S corporations, and where you receive a K-1 and the income passes to you through that entity on your individual tax return. It's also if you have a Schedule C or Schedule E filing as well, that where all the information is reported directly on your return, you could potentially be qualified to receive this deduction. And the deduction is a 20% deduction on pass-through income, which is basically subject to what they call in the law qualified business income. So what's kind of unique about this deduction is you don't have to spend any cash in order to receive this deduction. Pretty much any deduction you get on a return or a credit, there's some kind of form of cash that you have to spend to get it, or timing, some kind of timing where you have to plan ahead. In this case, this is a deduction. 20% of your income from that pass-through entity could be deducted on your personal tax return, all for the fact that it's just you're invested in that, your business is invested or investment is invested in that type of entity. So keep in mind, this is not for C Corps. This is only for pretty much any other entity other than C Corps. Now, an example I have, very simplified, you know, if you're an owner in a 50% real estate investment partnership, and you get a K1 and it's going to report $10,000 on the on the partnership return, will report $10,000. So you as a 50% partner, you're going to get a $5,000 rental real estate income flow to you that's going to be reported on your personal return. So in very general sense, what that means is you're going to get a $1,000 deduction, which is 20% of that $5,000 on your individual tax return. So qualified business income is basically most income that's reported to you from your K1 with the exception of capital gains and interest income. Now, where this gets a bit complicated, and this is where tax planning is going to become real important. So as I get through some of the, it's going to get a little more convoluted as I go along. So as I get through some of these discussions and examples, keep this in mind, some of these items that you can discuss with your ASL professional as the year goes on, and try to compile some ideas on how this deduction may work for you. So where it gets complicated is, so if you are, as an individual, report more than $415,000 as a married individual on your tax return, and I'm talking about your individual tax return, not your business pass-through, just 415, so that's going to be your wages, your business income, business deductions, itemized deductions, and you net to $415,000. Now you have a limitation. So you don't necessarily get 20% of your pass-through income as a deduction. You have to look to this limitation calculation, which is 25% of wages from that pass-through or Schedule C or Schedule E entity, plus 2.5% of depreciable property. And where that, and there's actually another limitation. It's actually the greater of that, or 50% of wages. And the reason why I highlight this one is basically because this is where it may be more applicable in real estate investments, because the first limitation, just the 50% of wages, well, you know, a lot of real estate investors may not have wages that are being paid through that pass-through entity. So therefore, in where I list down here below, referred to as the cork or kickback, you can use the second limitation, which is 25% of wages paid from the entity plus 2.5% of depreciable property. And if you remember in the news, right before the tax reform was passed, there was Senator Corker, and he came out and he basically was a little iffy about whether he wanted to pass this law, and he may have hung up this whole thing to even pass. Then all of a sudden, you know, in the joint committee, they came out with this pass-through change for this pass-through deduction to include 2.5% of depreciable property. Well, apparently Senator Corker had a lot of investments in real estate, and all of a sudden he changed his mind and wanted to get this law to go ahead and pass, and you know, he denied whether or not that was the case. But regardless, it just so is a little of a news reference. That's where this comes from. So it really benefits us as real estate investors that now, you know, to the extent if you were a high income earner over $415,000 in individual taxable income, now you have this option to still get a piece of this pass-through deduction. So an example of that is an individual reports $500,000 of taxable income, and keep in mind that's on the total on the individual tax return. Of that, $200,000 is from a pass-through entity, of which has 10% owned real estate investment. And in that investment is depreciable property within the entity of a total of $5 million. So basically what you have to do is, knowing that you're over the limitation as an individual, you have to break down the components. So first you take your $200,000, which is your share that's coming to your return from a K1, your individual return, take 20% of that, and now you'll show that you would have a $40,000 deduction, assuming there was no limitations. But because there's this potential limitation, you go to the limitation calculation, and you have to look at which one is lesser of. So for the limitation, you take the depreciable property. Keep in mind depreciable, not including land. And this is at original cost. So you have $5 million. 2.5% of that is $12.5. No wages happen to be reported in this because it's a real estate investment where no wages were being reported. Therefore, your total deduction there is 12.5, and because that is the lesser of the 40 stated above, your pass-through deduction will be 12.5. So you can see where that Corker kickback comes into play, because otherwise you would, had that not happened, you would have had $0 deduction on your individual return. So other things to note here are if your qualified business income exceeds taxable income, you have to use 20% of taxable income. So basically, this is where it becomes very important as an individual taxpayer to do the best you can in organizing your whole personal tax situation, or have some kind of awareness, especially if you're close to that $415,000 threshold. Because for tax planning purposes, if you think you're getting this, you hear in the news there's this 20% deduction, you think you're going to get a 20% deduction, you kind of have an idea of how much income you have in your business. Well, you may be severely limited based on this prior example that I'm showing, where you thought you were going to get a $40,000 deduction, but really you're getting 12.5. So it's really important to get a grasp of your taxable income. So in that first note there, this is sort of a different example, because if you look at the fact that you have business income and that exceeds your taxable income, well, the new law says, well, you can't take 20% of business income from the pass-through if your taxable income total on your individual tax return is less. So you have to take 20% of your taxable income versus the business income. If you get paid guaranteed payments, or the company pays out guaranteed payments, they don't qualify as business income, nor do they qualify as wages for the limitation purposes. If you're considered a specified service trade or business, so the law kind of, it breaks it down as healthcare, accounting professionals, lawyers. It has a pretty somewhat decent definition in there, but there is a lot of unclarity. And we're waiting on some IRS guidance on what's a specified trade or business. We have a pretty good idea in some cases, but then coming to the real estate side, well, what does that mean for real estate brokers maybe, or for a property manager? I don't think we're quite sure yet, and why is all this important? So, in general, yes, if you're an accounting professional, or you're a real estate property manager, well, yes, you can still get that 20% deduction. But what it does not allow for is to get that deduction if you exceed that $415,000 threshold on your personal return. So keep in mind, in theory, you could have $1 million on your personal return of pass-through specified service trade or business income, but if somehow you can bring your taxable income down with other losses and whatnot down to this under $415,000 threshold, you could still potentially get this deduction, 20% of specified service trade or business. What's important here again is you have to look to your taxable income. So on your individual return, it's really important to kind of get a grasp of that for many different reasons depending on your situation. So more to come on that, and we'll keep you guys informed, working with your ASL accountant and whatnot on, if you're not sure if you're in a specified service trade or business, we're working hard to try to figure that out with the new tax law, if there's some gray areas still left on your potential business. Another thing to note is if you have a pass-through, one with income and another with losses, and let's say the pass-through that had losses exceeds the other pass-through with income, well, when you net those together, you have a total pass-through loss. Well, you're still allowed to take a 20% deduction on the one from which you had income, but you have to hold that and carry it forward to another tax year. So again, another reason for tax planning in this case. You may not necessarily get that deduction right away, but you could definitely get it in a future year with some proper planning. All of this tax law, there's some good, clear items in here. There's some items that we're still trying to figure out. So all of us as CPAs over here, we're waiting on the IRS to come out with what they call technical corrections, notices, regulations, and anything to clarify questions that are unanswered that came through this past tax law. This deduction, along with a lot of other things that we're going to talk about today, have expiration dates. This one, no different. So unless there's any changes between now and 2025, this deduction goes away in its entirety. So keep in mind, as we go through all this, none of these items are permanent. And that's important to keep in mind, too, for, there's a lot of talk out there about, are we going to switch from a pass-through entity to a C Corp because C Corp has this new 21% flat rate, whereas if you're a pass-through entity making a lot of income, you could potentially have a 37% rate. Well, if you get the pass-through deduction, maybe this helps with the decision, and also the fact that, well, maybe it doesn't help as much because if this whole thing goes away in 2025, well, it's a lot to think about. And I know tomorrow's presentation is going to touch on, entity changing considerations, so keep that in mind. Moving on to like-kind exchanges. So really briefly, if you're not familiar with like-kind exchange in real general senses, as a real estate investor, if you have a piece of property, you sell it for a gain, and within 6 months you purchase a new property for a value that's at least as much as the value of the property that you sold, you can defer 100% of your gain until either you sell this new property again, or you could also exchange the property again and pretty much defer it almost forever, if that be the case. So prior law said you could do like-kind exchanges with what they pretty much defined as property. And so that could be what's called personal property, as in anything that's not buildings or land. So it could be with cars. There was talk about the news whether people are not going to do Bitcoin for exchanges because Bitcoin is defined by the IRS as property. Well, that's all going away, at least as of 2018, because and there's some thought to thinking that Bitcoin and certain things like that is the reason why. Is under the new law, they defined for exchanges you can only exchange real property, which is in general, high-level sense, buildings and land for business purposes only. So that's pretty much the only change in like-kind. So us as professionals that we got together and we're thinking about, well, what happens if you have a property like a residential real estate or a hotel that has kind of like a lump sum sale. So not only are you selling the building and land with your real estate, but you also have appliances, you have other deemed property that could be worth millions that's considered personal property, not real. Well, I think the good news is that it's not going to be something that's going to be an issue. It's probably going to be more beneficial than anything. We're thinking we're going to get more deductions out of this. We're thinking that potentially there may have to be some cost segregations done at the side of the purchase of the new property, maybe some valuations when you sell your old property. We don't have a definite answer yet of how this is going to all come to play, but just want to keep that in mind. If you're an owner of residential real estate that has all these personal property considerations in there, we're working on it to come up with a solution that makes it the most beneficial for you. And again, we're still waiting on IRS guidance on all this, so as we hear more from them, we can plan for all this much better. And with that, I'm going to turn it over to Yvette, who's going to go over some business asset expensing rules that have been a bit enhanced for 2018, and well, actually partially for this year, and she's going to get into all that for you.
So yeah, I'm going to start with bonus depreciation. As some of you know, with the prior law, you used to be able to take a 50% deduction on qualified new property. This section has been modified to increase that 50% deduction to 100% expensing, and this is going to go through year 2022. And then the phase down is going to begin at that year, with 2023 going down to 80% 2024 to 60%, 2025 to 40%, and 2026 to 20%. It is also very important to notice that even though this is a new law, it might potentially affect your 2017 tax return just because now property that has been placed in service after September 27 of 2017 also qualifies for this deduction. And the property just has to be placed in service and acquired after September 27 of 2017 in order for you to be allowed to take the deduction. So this is very important to take into consideration when you're preparing your 2017 tax return. Another change that was made there is that now for bonus depreciation, you can actually apply this to new and old property as well. So this is another big change that has been to that code section. I'm going to go ahead and start talking now about Section 179. One of the biggest changes there for real estate has been that now this code section has been modified to include non-residential improvements. Under the prior law, you used to be able to take Section 179 only on tangible fixed assets, and it excluded land and real estate. But where we're seeing the advantage here is that now commercial building improvements, such things as like roofs, HVACs, fire protection and security systems, are now allowed to be expensed under Section 179. Another change here is also that under the prior law, you used to be able to take a deduction for Section 179 for up to $500,000. Well, now with the new law, this has been increased to $1 million. So that's very important. Now I'm going to be talking about the mortgage interest deduction. Some of you might already have heard about this, but I'm just going to talk about some of the changes. So as some of you know, under the old law, you used to be able to take a mortgage interest deduction on your Schedule A for any acquisition indebtedness up to $1 million. You used to be able to also take a deduction for any home equity line of credit interest that you paid for up to $100,000. And this was regardless of how you use the proceeds. Well, now the home equity line of credit deduction is going to be suspended, and you're not going to be able to take that. And this is it's scheduled to be revert back after year 2025, as well as the mortgage interest. For acquisition indebtedness, the mortgage has been reduced from $1 million to $750,000. So that's a big change, especially for us here in the Bay Area, who we know that the houses are so expensive. So a lot of you might be affected by that. Also, another thing that you might want to take into consideration is that this limit, the $750,000 limit, it does not apply to any debt that was acquired on or before December 15 of 2017. If you enter into a contract, let's say before December 15, 2017, and your escrow closes on or before April 1st of 2018, then you're still able to take that $1 million limit on your Schedule A. As I mentioned before, after 2025, the acquisition indebtedness limit is going to revert back to the $1 million, regardless of when it was incurred. And I'm going to be moving on to the property tax deduction. As some of us know, under the old law, you used to be able to take an unlimited deduction for property, state, and local taxes. Well, that has changed dramatically. Under the new law, now the aggregate deduction for state, local, and real property taxes has been limited to $10,000 per year through year 2025. What is very important here for the real estate people that have businesses is that this limit, it does not apply to any income that you might be reporting on your Schedule C, Schedule E, or Schedule F. This limitation only applies to your Schedule A deductions for state and local taxes. As we know, people in California pay a lot of taxes to like state and property taxes, so we're going to be very affected by this change. California, though, they're attempting to pass this legislation to protect California residents from the $10,000 limitation. So far, this legislation, what it will do for you is it will allow you to, or California taxpayers, to make charitable donations to the California Excellence Fund, and in turn, the taxpayer can receive a dollar-for-dollar tax credit for their contribution. The taxpayer then will be able to deduct these contributions on their federal taxes. But that hasn't been finalized yet, so just keep an eye out to see any updates or any new things that California might be doing to help California residents. With that said, I'm going to go ahead and turn this over to Erika. She's going to be talking about the limitations on business losses.
Hi, everyone. Thanks, Yvette. I'm going to be talking about the limitations on pass-through losses, specifically on the excess business loss limitation. So the Tax Cuts and Jobs Act has amended Code Section 461. This section now provides that excess business losses of a taxpayer other than a C corporation are to be disallowed during the taxable year. So this affects taxpayers with investments in sole proprietorships, partnerships, S corporations, LLCs, estates, and trusts. So you may be wondering, what is an excess business loss? So excess business losses are net pass-through business losses in excess of $250,000 for single taxpayers and $500,000 for married filing joint taxpayers. So basically, if you sum all of your K1s, Schedule C and Schedule E, rentals and other investments, and you're a married filing joint taxpayer, and all of your losses exceed $500,000, you're only going to be limited to $500,000 for that year. Any losses that are over this $500,000 threshold is going to be deducted. Is not going to be deducted in the current year. So instead, it's going to be carried over to the following year as a net operating loss. And if you don't use it, it's going to be carried forward indefinitely. So I have an example here to make it, to illustrate it a little bit better. Tom is a single taxpayer, and he has net losses of $300,000 from his sole proprietorship business. Let's assume he doesn't have any other activity on his 1040. Tom will have $50,000 as an excess business loss, because if you subtract 250 from the 300 loss, you get the difference is $50,000. So that's going to be your excess business loss. And so those $50,000 are going to be Tom's net operating loss, his NOL, and he's going to use that for the subsequent years. Now let's talk about investments in partnerships and S corporations. So if you're a taxpayer with investments in these entities, the rules are a little bit different. Well, they're not different. It's just that the partnership and for partnerships and S corporations, excess business loss limitation rules apply at the partner and shareholder level. So to illustrate that, I have an example here. John and Mary start a real estate business as equal partners. John is a single taxpayer, and he invests $500,000 in the business. And Mary, she's married, and she invests $500,000. So they both put in the same amount of capital. In 2018, the partnership reports a net loss of $700,000. So that means that they're both going to get $350,000 loss on their Schedule E. But since now we have this limitation on excess business loss, John is only going to be able to, John has an excess business loss of $100,000. So if you do the math, 350,000 minus 250,000, the difference is 100,000. So his excess business loss is 100,000, which will in turn, it's going to turn into his net operating loss. On the other hand, Mary has no excess business loss. So if you do the math, well, if you $350,000 is less than 500,000, so she's not going to have an excess business loss. But something to keep in mind is that this is a passive activity because it's a real estate, probably like a rental property or something, and this is a passive activity. So Mary can only deduct the $350,000 loss against passive income. And this might spark the question as to how is the excess business loss rules going to coordinate with the passive activity loss rules, and that's a fair question. So Code Section 461 applies after the application of the passive loss rules of Code Section 469. In other words, passive loss limitation rules apply before excess business loss. So if we go back to the example that we have on the screen here, Mary can, like I said, Mary can only offset the $350,000 loss against passive income. So first is the passive activity loss rules, and then the application of the excess business loss rules. Now I'm going to get into the changes to the net operating loss deduction. So the Tax Cuts and Jobs Act has amended Code Section 472, which limits the net operating loss deduction. As you know, NOLs, or net operating losses, are created if in one tax year you incur business losses that exceed taxable income. And before the law, there was no limit on the amount of NOL deduction that you can take during the year. So I have an example of how we used to do it pre-law. So for example, let's say in 2018 you had taxable income of $300,000, and you had a net operating loss carryover from 2017 business losses of $400,000. So your NOL was $400,000. Your current taxable income would be zero, and you would have $100,000 of NOL carryover to 2019. So this was before the new law. Now it changes. Now NOL deductions are limited to 80% of your taxable income. And to illustrate this, I have an example here. So let's assume the same facts, but now with the new law. You have a taxable income in 2018 of $300,000, and you have an NOL carryover from 2017 of $400,000. So your current taxable income is going to be $60,000 instead of zero. Now it's $60,000. And how do we do that? So you're going to multiply 80% of your taxable income, and that will get you the $240,000, which you will subtract from your taxable income. And the difference, you're gonna have to pick that up as taxable income, the difference. The remaining net operating loss that you didn't use for that year is going to be carried over to 2019. In this case, it's $160,000. This, like Mike was explaining, this will expire there's an expiration for this as well in 2025. And as you remember, in prior law, there was your NOL, you can carry it back 2 years and carry it over for 20 years. But this has changed as well. So now you can't carry it back anymore. You can only carry it over indefinitely. So now it doesn't expire after 20 years. You can carry it over indefinitely. So with that, I'm going to turn it over to Mike, who is going to give us a summary of what we have covered today.
Yeah, just before I get to the summary, I'm just going to go over a couple other topics. These may be kind of considered smaller topics now in terms of under real estate for what we believe, a lot of us have seen, but one is carried interest, and I know there was a lot of talk about carried interest in tax law. It definitely is something that applies mainly to like hedge fund managers and as well as real estate investors. So And where it does in real estate business is, let's say you have own a real estate property, have a bunch of employees, and as part of a incentive for the employees, part of their compensation, you reward them a profits interest in that building. In a sense, that's carried interest because they're receiving compensation, which is normally taxed at ordinary rates, but they're going to receive it as a form of capital gain when that property sells. Well, when it comes to the new tax law, basically the change for us as real estate professionals, it used to be where you just have to hold the property for a year to get that capital gain treatment, at least as a profits interest, or for anybody for that matter. But now if you hold a profits interest as a carried interest, the holding period for that property has to be at least 3 years. And in my experience, most properties held at least 3 years. So it may be a non-issue to a lot of you, but it's a technical law change. There's also a business interest expense limitation. Basically, that law works as you're limited to 30% of adjusted taxable income of your interest expense. Just noting it here, there's a small business exception where if you have average gross receipts of over $25 million over the last 3 years, you don't have this interest limitation. If you do happen to have a building that generates over $25 million in income over 1 year, this is something potentially to pay attention to. Real estate professionals have the option, although, to opt out. You just have to change your depreciation method in order to be able to opt out. And so there's pros and cons with each. So something to look into potentially if you have a high cash generating real estate business. So in summary, I'm going to go back to the topics here just to refresh what we discussed. So, going over this whole pass-through entity deduction, again, huge planning opportunity, huge deductions potentially out of this. This is something, like I said, we haven't seen anything quite like this. Something to really start considering and thinking about if you have a pass-through investment, if you have a Schedule C or E. Again, you look to your taxable income first, I think. Also, because that is a potential large driver of this whole deduction. Something to discuss with your CPA on is first, where's your taxable income at? Where's the income from your pass-throughs? What kind of potential do we have for this? Are you in a specified service business where you may be limited? All good questions, all things to go over, and all things to consider, and whether or not you're going to be able to take advantage of this, or maybe there's something we can do to maneuver something for you in order to be able to take advantage of this if your current situation otherwise says you may not get a good deduction out of that. Likekind exchange rules, again, nothing big to change there. We're just going to keep you informed to the extent of what we can do with your properties if you have both real and personal property associated in a sale. One thing I don't think I mentioned earlier is if you currently have an exchange going on and where the exchange originated in 2017 and you had not yet purchased, or you purchased your replacement property in 2018, well, to the extent there was any personal property during that exchange, the old rules still apply. So there's nothing to worry about in terms of how are we going to handle this on your return. So this is only for if you have a sale of property that initiates in 2018, where these new Likekind rules apply. Business asset expensing. Again, I think that's really interesting. Really good highlights to notice are the fact that used property is now allowed for 100% bonus, where that was never allowed in the past for bonus. When it comes to 179 as real estate professionals, a really huge opportunity is if you need a new roof, HVAC, fire, security system, it's clearly in the code that you are allowed to take a full deduction on this now. And a great example, I think, of this that could potentially really benefit people are if you haven't had a cost seg on your property before and you're thinking about buying a new roof, go ahead and potentially you might need to get that cost seg, because let's say you bought this property at lump sum. The property was pretty much just broke out as building and land on your tax return. You're ready to buy a new roof. Well, what current and old law says is if you know the allocation of that old roof, you can go ahead and deduct fully the amount of that old roof and add the new roof on your depreciation schedule and basically depreciate over 27 or 39 years depending on what life you have to choose for what type of property you have. And so people would go and get a cost seg and they'd find out how much that roof is allocated and go ahead and go with that. But what's interesting with the new law is not only can you go get a cost seg, write off the cost of the old roof, but now you can fully write off the cost of the new roof, and you could get a very potentially large deduction. So I see a lot of good potential out of this new part of the law for real estate investors. Also, as Erika went over with the pass-through, the pass-through losses and the NOLs, this is more the downside. Now, if you're always consistently paying tax every year, these changes don't apply to you. But to the extent if you're a real estate professional, and I know there's plenty out there who get these large deductions, depreciation deductions, interest expense, whatnot, and they're constantly incurring great losses and being able to shelter any taxable income that they have to pay taxes on. Well, this is where, for you, this is going to be a little bit tougher because there's a very high likelihood that you'll have to pay some tax. Now, again, I don't know that it's going to be a large amount of tax because we're still getting, you're still getting use of your NOL, and you still get up to a $500,000 pass-through loss, but there's a good chance you may have to consider start paying taxes. So you may want to check into that, do some planning if you normally don't pay taxes, and potentially see how much are you going to have to pay, plan for that, save for that, whatever needs to be done, and somehow make some changes within your structure to maybe minimize the amount of tax that you're paying. Also with the NOL, for those who are aware, you may have, to the extent you had NOLs, we were allowed to carry those back in years where you may have had income. Well, that went away completely. Now you only carry forward NOLs. I think that's a pretty noted change in the new tax law as well. And then again, as Yvette discussed, with also changes in the mortgage interest and the property tax deductions, I think a lot of people are aware of that because those are big highlights in the news, especially for us living in California. That's a big potential hit. I don't know that that's necessarily a big hit to people who are typically in AMT, especially regarding that property tax deduction, because if you were an AMT, there's a high likelihood you may not have been getting an advantage regardless for that property taxes that you paid. So it may be nothing to you, but to the extent that you were, you may see your taxes go up a bit on that as well. So all good reasons to do tax planning, plan ahead, get an idea of what you have going on. We can run numbers periodically, see where you're at. Since that 2018 tax year, I know it's just started now, but always good to plan ahead as far in advance and see where we can help you out with. And with that, I believe we've gotten through pretty much all the information that we had on our presentation. So I just wanted to highlight, here's our contact, my contact information, my email up there and phone number. So go ahead and give me a call if you have any questions. Email me. If you already work with someone here at ASL, if you have any questions on anything, please go ahead and give somebody a call and see if we can't get some of this figured out for you. With that, we'll go to some questions. So we got a few here. One question I have is, does land qualify as depreciable property for the real estate pass-through deduction? And it does not. So you only have, keep in mind, you're only looking at depreciable property when it comes to that deduction. So that could be all depreciable property. Anything that's basically on your fixed asset schedule at cost, that's the amount that you use for the limitation calculation on your pass-through deduction. Another question that came in, does the 20% deduction apply to 3 rental properties to a sole proprietor entity owning them versus them in an LLC? Yes, it does. So as a sole proprietor, you're going to basically file rental properties on a Schedule E. Anything that's on Schedule E can potentially qualify for that 20% deduction. You just have to understand your situation in order to see if you can take advantage of that. But initially, in general, yes, you can qualify. Another question, if you're a wholly owned S-Corp, is it best to optimize pass-through deduction by minimizing wages and maximizing profit? It's a tough question because I think it really depends. So basically, is it best to optimize pass-through deduction by minimizing wages and maximizing profit? I really think it depends. I mean, it depends on if it could be an option. It also could be an option to maybe defer some expenses in your situation. But it also could be, well, what if there's too much profit, and therefore you may have that limitation rule that applies. So I think in any given situation where you try to figure out how to figure out whether or not you're going to get this pass-through deduction, you really have to look at your personal situation, the shareholders or LLC members' situations as well, and try to get an idea of where everybody's at on their personal level. Another question that came in, if a manager, LLC, or general partner, is it best to give them an employment contract to get W-2 since guaranteed payments are not counted? So if you're referring to a LLC owner, technically LLC owners or GPs are you're not allowed to get W-2 wages. So I don't know that can be an option for you in order to get the pass-through deduction as far as if you're looking for the wage sense. Now, when it comes to wages, it's not the wages that you receive, it's the entire wages that are paid out in the entity. So, for instance, if you any employees that you pay out, the way I envision this with the pass-through deduction is the K-1s are going to change a bit, where we're going to start reporting your allocation of depreciable property, your allocation of wages that were paid out of the entity. And with that information, it should help guide to whether or not you can take advantage of that deduction. Next question, do the enhanced business asset expensing allow a business renting a building accelerate depreciation of the tenant improvements to the current year? To allow a business renting a building accelerate, I think if I'm understanding your question, I believe there's no reason it shouldn't. You should be able to accelerate, depreciate. So like with tenant improvements, in general, they're going to qualify for either 179 or bonus, and in this case, I don't believe it should be any different for you. And another question I have, are real estate taxes for rental property subject to the $10,000 California tax? No, they are not. If it's a real estate tax for a rental property that you're reporting on a Schedule E as a business, basically the difference is, you think of it, if you're treating your property as a business, then it's not capped. You should be able to, in theory, you should be able to get a full deduction. This applies only to where you have itemized deductions on an individual tax return. So, and keep that in mind too. That's combined with your state tax deduction. So if you have state taxes already, like a lot of us in California do, that already exceed $10,000, well, you get no benefit for your property taxes paid at the individual level for your personal residence. And I believe that's all the questions we have in. Unless any other questions come here in the next minute or so, we'll probably go ahead and sign off a few minutes early. Yeah, so is recording available? There was actually another question out there. Sorry, I missed that. If you missed the majority of this presentation, keep in mind, if you go to the ASL website, there is a recording of this that'll be, I believe, in a couple days on our YouTube channel. So just search out for that YouTube channel. To the extent anyone can't find it, feel free to email me or anyone here at ASL that you're familiar with, and we can get you set up with an audio recording. Another question did come in, how do we download the deck from this presentation? So to download the deck, go to the multimedia view. It should be at the top right corner, I believe, of your screen. And if you go ahead and click there, it should bring up the presentation from there. Again, if you need any assistance, you can go ahead and email me, and I can get you a copy as well. But I think with that, I appreciate you guys for listening to us, and I hope our information was helpful to you. Again, I think the theme of this whole thing is increased tax planning, increased opportunities. There's some good and bad out of this, but with planning, I think we can make everything, potentially better for you, or at least minimize the bad side of it for you to the extent we can. So again, I appreciate it, and we'll say goodbye.